Welcome to the Debt Doctor podcast, where we deliver the definitive prescription for navigating distressed real estate debt. I'm your host and America's most qualified debt doctor, Bill Bymel. I've spent my career investing in, diagnosing, and reviving thousands of distressed real estate situations. The Debt Doctor prescribes proprietary remedies to help you identify, acquire, and monetize undervalued real estate assets. Each episode gives you insider access to the strategies top cohorts use to transform market volatility into double-digit returns. If you enjoy what you hear today, hit the follow button, subscribe so you don't miss an episode, and please share your support with a quick review. You can find me on the web at billbymel.com. Thanks for joining this episode of The Debt Doctor. Hello, and welcome to The Debt Doctor. I'm your host, Bill Bymel. We're here in New York City at the Blackstone Building on Park Avenue with this amazing view of downtown New York. I'm here with my good friend and colleague, Ron McMahan, and we're here to talk a little bit about market dislocations in real estate in 2025. Ron, thanks for being here.
Thank you.
So we've talked a lot about the fact that commercial real estate seems to be a canary in the coal mine. While there seems to be a ton of equity still in residential, there's this kicking the can down the road in terms of commercial real estate, kind of a repricing that seemed to happen in commercial real estate, and that hasn't yet been realized by those that owe debt on real estate. Would you agree with that philosophy?
Yes. Today, the situation with a lot of commercial properties, especially small balance properties, which are defined by those properties and loans worth less than $8 to $10 million. The properties are extremely over-leveraged and very under-collateralized. It's very analogous to the situation that existed in the residential market in 2007 through 2009, when homeowners were taking out 20% seconds, their loans were 110%. Whatever that situation might be, there was much more debt on the property than the property was worth at that time. So we recently were awarded a mandate on a portfolio of about $300 million of loans. When we were awarded that mandate to special service those loans, about 75% of the loans were in default or maturing within 90 days. The average loan to value on that portfolio of bridge loans was 135%. What I mean by that is that the loan amount was 35% more than the average values of the properties securing those loans.
And that's the dislocation. I mean, there have actually been originators out there, like this one that you're talking about, that gave hundreds of millions of dollars of small balance commercial bridge loans when they thought they were giving those loans at 80% or 70% LTV, and they were actually giving them at 130. Now, some of that change, some of that what we would call dislocation, was caused by the change in interest rates a few years ago. But a lot of these loans was just fraud or just misvaluation and greedy originators that were willing to originate anything they could get approved for a fee. Is that what happened?
Well, it's interesting because a lot of the same underwriting techniques, or lack of technique, shall we say, that took place during the subprime crisis, say from 2001 through 2007 or 2008, were exactly the same mistakes that underwriters made today. There was an extreme amount of borrower fraud, but there was very poor underwriting. Lenders were making loans for millions of dollars and never visiting the property. They were not verifying through third-party validation of documents internal rent rolls. They were not verifying appraisals. There was no comps. It was almost a free-for-all, especially in the private lending industry. And also LTVs on loans kept going up and up and up, to the point now where you see a lot of private lenders giving fix and flip loans on 1 to 4 properties at 95 or 90% of the current property value. That's just the recipe for another subprime crash, except this time it'll be in small balance commercial.
Well, you hit the nail on the head when you say subprime, because you and I have been around long enough to know, the word NONA loan, no income, no job, basically. Just state your income, right, or just make it up.
No, in small balance commercial, I'll give you a new term, Bill. Right now, it's called the NONA loan. No obligation, no appraisal. What that means is the borrower doesn't sign a guarantee and the bank doesn't get an appraisal. And what that means is they're going to call me next week about a defaulted loan.
Yeah. I mean, every day we're looking at tapes. I just looked at a tape this morning that had 12 from a bank, where there's just no way they could have ever thought that these appraisals no one must have looked at these when they got originated.
Yeah, not only the appraisals, Bill, but also the sponsors. A lot of banks lent money to businesses that were not viable, or, basically when you're doing a commercial loan, you should be evaluating the cash flow, that it's substantial enough to make your mortgage payments. You'd want to look at the collateral value. You don't want to make a bet on the business only. But what's occurred here is a lot of bad businesses got loans on properties that the business operators owned, and unfortunately those businesses have gone sour. The worse the economic environment gets in the United States, like for example right now everyone's raising the percentages of a recession down the line. Goldman Sachs just recently raised, I think, over 50% probability of a recession. You'll see even more small balance loans fail. Everybody hears about the large office buildings in various cities that get sold for 10% or 20% of the loan amount. The real problem is in America, where these small balance loans, the losses that are going to come are going to greatly eclipse, in my opinion, what occurred during 2007, say, through 2010 in the resi space.
Right. I guess the only thing that's different is that, thank gosh, commercial in general is a smaller actual dollar volume total, which you wouldn't think of, but in terms of the mortgage market itself, $4 trillion, $14 trillion. That said, going back to the subprime conversation, which was the residential, what I've seen, and I think you've definitely seen this, is that the guys that used to work at Countrywide, and which was obviously ground zero for subprime, are guys that went into the private commercial lending space the last 10 years.
Yes, unfortunately. Yes.
Well, that said, so where does that leave us today? I mean, we know there's dislocation. People have been talking about it in commercial, almost to the point where, we talk about to some of our colleagues, and they're like, yeah, we'll believe it when we see it. You and I are on the front line, so we're starting to see it. We're starting to see an increase in NPLs, more banks wanting to sell loans finally. Where does this dislocation end up, in your opinion? What does 2025 look like, and what kind of opportunities might exist?
An easy way to look at it is, I think banks will be able to work through a lot of these issues on down to the smaller banks. Where the losses are going to be horrendous is in the private lending sector and in local kind of semi-institutional lenders. In the last, say, 7 or 8 years, you've seen nobody ever heard of a fix and flip loan before 2014 or 2015. Now that's all you hear about.
Right.
Everyone, there's TV shows about it. Everyone can go out and remodel their house. They can get rich fixing and flipping loans or fixing and flipping houses. There is no question that the largest private lenders in the United States right now, in fact, I can tell you that I know 4 or 5 of very high senior executives at the 10 largest lenders, and they all have default rates in excess of 15 to 20% of their current portfolios. So that is a huge problem for them, and private lenders also don't have the capital reserves that banks do. They haven't been reporting. They've been doing what's called extending and pretending. So what we look at is a complete tsunami of debt coming. The question is, how do you profit from it? Well, you can try to profit from it the same way that you did back in '07 through '12 when people were buying houses and fixing them up and flipping them. It's not the same in the commercial world. You can't go down to the local strip mall and fix that up and flip it as quite as easily as you can the house down the street.
Yeah, for sure. So it means workouts, it means taking back price properties, it means repricing the market. I mean, that's really, it's just a one-by-one kind of scenario.
Yeah, it means workout folks need to have a complete solution. They need to be able to originate a new loan. They need to be able to work out a loan. They need to provide special servicing, and they need to partner with the sponsor. A lot of these guys, these businesses are the retirement accounts, and the way that they plan on, as a substitute for a normal person who's got a pension fund or something like that. So you need to work with them to help them maintain their financial integrity. You're going to have to invest in their property. You're going to have to become their partner. Mm-hmm. It's not something where you can just go in and large-scale evict or foreclose on thousands and thousands and thousands of multifamily properties, for example.
Right.
You're going to have to partner with these people, and that's why that's the business that we've started. And over the last year, we've probably worked out about 300 million of those types of loans, and I expect it's going to grow probably tenfold over the next 4 to 5 years.
Yeah, and having been working through these, you pointed it out. You enlightened me a few months ago, because I always thought of commercial real estate as a big boys club, an institutional space. The stuff that you read about in the newspaper is when a Chicago downtown loop building sells for $10, right? So you think that that's a big boy space, but in reality, when you look at small balance commercial, which is what we classify as under 10 million in value, there's a pretty large percentage of that is just regular folks trying to, create a nest egg or a second income.
Yeah, there's a real misunderstanding, and I think we've touched upon this before, but just like in single family, single member LLCs or individual investors own 90% of the non-owner occupied single family properties. In small balance commercial, it's 78%. So it's the same people.
Wow.
They have the same problems. They're not as financially sophisticated. They don't have capital reserves. They're already running on tight budgets because of maybe 2 or 3 of their tenants aren't paying their rent or their leases, whatever the situation may be. So it is a tough situation. It is highly analogous to what occurred, roughly 17, 18 years ago in the resi space. Mm-hmm. And I think it's going to take 5 to 7 years to work out just like it did in the residential space.
Yeah, I think you hit that nail on the head. I mean, that's the thing. It's doctors that own a multi-office that they have 4 other doctors that are tenants. It's got, lawyers and policemen and firemen that graduate from single-family rentals to a 12-unit building. The loan they got 5 years ago is now maturing, and the rates are 3 points, 4 points higher. So it doesn't work.
Yep, exactly.
Do you think the impact of insurance will having anything to do with this?
Horrible impact.
Yeah.
I mean, in places like California and Florida, it's different environmental concerns, but they have the same problems. A really good friend of mine, where I live in Southern California, he's an Allstate insurance agent. 38% of his book was canceled. And
wow.
Yeah, and he's all California, but it's horrible for them, and it's horrible obviously for the homeowners and the business owners that own those properties.
Yeah, and it's what's really interesting about the insurance conversation is prior to the last 3 to 4 years, it seemed like you could easily say, okay, it's California wildfires and Florida hurricanes, or maybe some Gulf states. Now you're seeing hurricanes hit Jersey. You're seeing hurricanes hit the Carolinas. You've got the tornado events all around the middle states. I mean, this is not just isolated to any one.
I'm surprised at you, Bill. Are you trying to say climate change is real?
How dare I?
I hope you're not supporting DEI as well.
That's right. No, I mean, it's obvious at this point. The reason insurers are charging us more is because we are seeing multi-billion-dollar weather events every month, as opposed to what used to be once a quarter. And it's affecting all parts of the country. One of the things I've been saying is for so long, it's PITI, principal, interest, taxes, and insurance. For so long, the T&I could just be forgotten, because it was a pretty steady number. Maybe you'd see some increases. Now, when you've got insurance rates doubling, and this is a residential and commercial problem, I know people in Florida where their insurance monthly nut is more than their mortgage payment now.
Lots of people.
So how do they plan for that?
And that is applicable to small balance commercial as well.
Yeah.
Again, they're not sufficiently capitalized to absorb that increase in their taxes and insurance.
Yeah.
And
it's those moms and pop investors that did gross leases.
Yeah.
So it's coming out of their pocket.
No, exactly.
Well, so I appreciate your perspective. Any thoughts, any bold predictions for 2025? We're recording this now in, what day is this, April of 2025? And we've obviously faced several months of volatility, and especially several weeks. We're starting to see the stock markets with huge swings. Any bold predictions for this year?
Yeah, default rates in commercial lending are going to just skyrocket. They have to. You've heard me characterize the default as a tsunami. Mm-hmm. Well, there's also something called the maturity wall. And the maturity wall is when these small lenders run out of money to lend because they're not recycling their capital because they're extending everyone. Mm-hmm. So they're not getting paid off. And none of the borrowers in their current books qualify for new loans.
Right.
So their capital is not being replaced by any third-party capital. So the pending maturity wall coupled with the tsunami of debt that's hit already and is starting to hit is just going to create real havoc for lending in the small balance space.
And I think you hit the nail on the head when you said that it was private equity is the unknown factor. It's really in that space because it used to be that the majority of commercial lending in real estate was still done by the banks.
Yeah,
and that switched over the last 10 years.
Yeah, and very large institutions, specifically focused on commercial lending. Now everybody, go look on LinkedIn. Look how many private lenders there are.
That's right.
And half of them don't even do it full time. They're part-time lenders, and they do 2 or 3 fix and flip loans a year.
That's a wrap of today's episode of Debt Doctor. I enjoy bringing this content to you each and every week, and I really appreciate you tuning in. Remember to follow us so you get notified whenever new episodes release. If you haven't already done so, please share one of your favorite episodes with a friend, family, or colleagues. And if you don't mind, leave us a positive review on Apple, Spotify, or whatever your favorite listening platform might be. Until next time, thank you for investing your time with us on The Debt Doctor.